Welcome to a new episode of Inside the Economist's Mind. Today on this deep dive, we're plunging into the global financial crisis of 2007-2009, a period that sent shockwaves through the world economy and, well, continues to be a subject of intense analysis.
Absolutely. It was a truly systemic event, and while we often talk about the causes, it's crucial to remember that the debates around, the precise weight of each factor are still very much alive. It wasn't really a simple story with a single villain.
Right. And to make sense of this complex picture, we've got a detailed explanation of the GFC as our primary guide. Our mission is to dissect how it all began, the sparks that ignited the fire, how it then spread like a contagion across the globe, and what the lasting consequences were. We want to give you the essential insights, cutting through the jargon, and hopefully offering a few of those aha moments. Okay, so let's start at the beginning. What was the economic landscape like in the lead up to the crisis?
Well, the years preceding the GFC were marked by what appeared to be a remarkably benign economic environment, particularly in the U.S. and many other developed nations. Think steady, stable growth, low inflation, unemployment at pretty comfortable levels, and relatively low interest rates. It seemed like a recipe for continued prosperity, really.
Sounds almost too good to be true, right? Like the financial equivalent of a long, calm summer. But our source points to a key feature of this period that, looking back, seems like a flashing red light: the rapid escalation of house prices. It was almost as if everyone had decided that property was the one-way ticket to wealth.
Exactly. And this wasn't just a gradual climb. In many regions, house prices were soaring. What's fascinating here is the pervasive belief that this trend would just continue indefinitely. This expectation, this almost unshakable faith in ever-rising house values really set the stage for the house of cards that was to come.
Which neatly brings us to the next critical piece: borrowing. It seems this widespread conviction about property prices fueled a significant increase in borrowing, particularly in certain segments of the market.
That's absolutely right. In the U.S., we saw excessive borrowing by households, especially among subprime borrowers, individuals with a higher probability of default. But it wasn't solely a U.S. phenomenon. Property developers and households in several European countries, Iceland, Ireland, Spain, parts of Eastern Europe, also took on substantial debt, all predicated on the same assumption of continuously inflating property values.
And this wasn't just taking out slightly larger mortgages, was it? Our source highlights loans being granted for amounts very close to, or sometimes even exceeding, the purchase price. That sounds incredibly precarious for the borrower, leaving them with no equity buffer at all.
It was exceptionally risky. And we also saw a surge in speculative activity with investors engaging in house flipping, buying properties with the sole intention of quickly reselling them for a profit. That strategy hinges entirely on the market continuing to go up and rapidly.
Okay, so we had this environment of readily available credit and a widespread belief in perpetually rising house prices leading to increased borrowing. But lenders were the gatekeepers here, weren't they? What role did they play in allowing this to happen?
Lenders were absolutely pivotal. There was intense competition among them to issue more and more mortgages. In this environment where profit seemed guaranteed, the urgency to originate loans often overshadowed, well, a rigorous assessment of whether borrowers could actually afford to repay. The prevailing wisdom, as you said earlier, was essentially, don't worry, the rising house prices will cover everything.
So it was a system where the incentive was just to lend, 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 and worry about the consequences later, if ever.
Precisely. And here's where things get particularly complex. These lenders weren't typically holding these loans on their own books for the long term. Instead, they were selling vast quantities of them as mortgage-backed securities, or MBS. Think of these as investment products created by bundling together thousands of individual mortgages, often with, varying levels of risk.
Right, I remember hearing about these bundles of loans. So they were taking these individual debt obligations, some solid, some shaky, and repackaging them into something new. How did this contribute to the unfolding crisis?
Well, over time, these MBS became incredibly intricate and, frankly, opaque. It became exceedingly difficult to truly understand the nature and extent of the underlying risks within these bundles. Yet, despite this increasing complexity, external credit rating agencies were assigning them very high safety ratings, often AAA, the highest possible. It's like giving a top safety award to a car without properly inspecting the engine or the brakes.
That seems like a fundamental flaw in the system. You have these increasingly risky loans being packaged together, yet still receiving a stamp of approval as safe investments. Why were investors so willing to buy them?
Investors, including major banks, both in the U.S. and internationally, were mistakenly perceiving MBS as low-risk assets that offered relatively attractive returns compared to other options in a low-interest rate environment. The logic was, look, even if a small percentage of the individual mortgages defaulted, the vast majority would continue to be paid, making it a seemingly safe overall investment. They looked at the headline mortgage backed security and often didn't dig deep enough into the quality of the mortgages within.
So it's like they were relying on the assurances of the rating agencies without doing their own thorough due diligence. And this demand for MBS led to another layer of vulnerability. Banks and investors started borrowing heavily to finance their purchases of these securities.
Exactly. This is where the concept of leverage becomes crucial. By borrowing increasing amounts to fund both the origination of loans and the acquisition of MBS, financial institutions and investors were amplifying their potential profits. But, and this is the critical point, they were also dramatically magnifying their potential losses. Think of it like using a small amount of your own money to control a much larger asset. If things go well, your returns are great. But if the asset's value drops, your losses are disproportionately huge.
So it wasn't just about the inherent risk in the mortgages themselves, but also the amount of borrowed money piled on top. And our source mentions a growing reliance on short-term borrowing as well.
Yes, many banks and investors increasingly depended on very short-term funding, sometimes even loans that had to be repaid overnight, to finance their holdings of less liquid assets like MBS. This created a significant fragility. It was like constantly having to refinance a massive debt every single day. If those short-term credit lines dried up, which they eventually did, these institutions were in serious, serious trouble.
It sounds like the entire financial system was operating on a razor's edge, built on the assumption that everything would continue smoothly. And we touched on it earlier, but it seems like regulation, or perhaps the lack thereof, played a significant role in allowing these risks to accumulate.
Absolutely. The regulatory framework governing subprime lending and the creation and sale of these complex MBS was simply inadequate. There wasn't sufficient oversight of the institutions that were creating these risky loans and then packaging and distributing them throughout the financial system. The watchdogs, in many respects, weren't equipped or empowered to see the full picture of the risks that were building up.
So there weren't enough safeguards in place to prevent this kind of excessive risk-taking.
Precisely. Furthermore, our source points to the prevalence of fraudulent activities, such as borrowers overstating their income to qualify for loans and misrepresentations about the safety and quality of the MBS being sold to investors. And in the early stages of the crisis, there was a significant underestimation by central banks and governments regarding the sheer scale of the bad loans and how widely the mortgage losses were spreading.
It sounds like a perfect storm was brewing. A cocktail of risky lending, bewilderingly complex financial instruments, weak regulation, and a collective failure to grasp the potential for widespread contagion. So what was the specific event that finally triggered the collapse?
The critical turning point was the peak and subsequent decline of U.S. house prices, which occurred around mid-2006. Simultaneously, the supply of new houses on the market in some areas was also increasing significantly. As house prices began to fall, a growing number of borrowers, many of whom were already heavily indebted, found themselves unable to keep up with their mortgage payments.
And it wasn't just that they couldn't afford the payments anymore. In many cases, the value of their home had dropped below the outstanding balance of their mortgage, leaving them with negative equity, right?
Exactly. This created a powerful disincentive to continue paying. Why keep paying for an asset that's worth less than you owe on it? The sensitivity of loan repayments to house prices was particularly acute in the U.S. due to the high levels of household debt accumulated during the boom.
So as defaults began to rise, the cracks in the financial system really started to show.
Precisely. Starting around mid-2007, lenders and investors began to experience substantial losses as they repossessed properties that could only be sold for less than the outstanding mortgage. This also led to a significant decrease in investors' willingness to purchase MBS, and many started actively trying to sell off their existing holdings.
Which in turn would have further depressed the prices of these MBS, creating a kind of downward spiral.
Exactly. As MBS prices plummeted, the value of these assets held by financial institutions and investors also declined sharply, eroding their capital and hitting their net worth. And those who had financed their MBS holdings with short-term loans faced increasing difficulty and, in some cases, impossibility in refinancing those loans. This further intensified the pressure to sell MBS and drove prices down even more rapidly. It was a vicious cycle of declining asset values and tightening credit.
It's clear that the problems in the U.S. housing market didn't stay within U.S. borders for long. How did these stresses propagate across the global financial system?
There were a couple of key transmission mechanisms. Firstly, as we've discussed, foreign banks had significant involvement in the U.S. housing market during the boom, including substantial purchases of MBS, often financed with short-term borrowing in U.S. dollars. Secondly, major U.S. banks had extensive operations in numerous other countries, creating direct interconnections between financial institutions globally. These linkages meant that when the U.S. housing market faltered, the repercussions were quickly felt by financial systems and economies worldwide. It really was like a domino effect.
And this all culminated in the peak of the crisis, often marked by the collapse of Lehman Brothers in September 2008. What was so pivotal about that particular event?
The failure of Lehman Brothers, along with the failure or near failure of several other prominent financial institutions around the same time, triggered a full-blown global panic in financial markets. Investors worldwide became intensely risk-averse and began withdrawing their funds from banks and investment funds because there was profound uncertainty about which institutions were solvent and how exposed they were to these toxic assets. Think of Lehman Brothers as a critical support beam in a large structure. When it collapsed, everyone holding onto that structure suddenly felt it was unstable and rushed for the exits.
So it was a massive erosion of trust and a freeze-up of the entire financial system. Basically, nobody knew who was safe.
Exactly. This led to severe dysfunction in financial markets. Everyone was trying to sell assets simultaneously, and many institutions that desperately needed to borrow money simply couldn't access financing. This seizing up of credit markets had a direct and immediate impact on the real economy, as businesses became reluctant to invest and households drastically cut back their spending due to plummeting confidence. The consequence was deep and synchronized recessions across the U.S. and other major economies.
A truly terrifying period with far-reaching consequences. But governments and central banks did eventually respond with significant interventions. What were some of the key policy measures implemented globally?
Initially, central banks began to lower interest rates in late 2007 in an attempt to cushion the slowing economic activity. However, the policy response became much more aggressive following the Lehman Brothers collapse. We saw rapid and substantial cuts to interest rates, often pushing them down to near zero. Central banks also engaged in large-scale lending programs to provide liquidity, or basically cash, to banks and other institutions that had sound assets but were facing a shortage of funding in the frozen markets. And then there was quantitative easing, or QE, where central banks purchased significant amounts of financial securities to further ease market conditions and stimulate economic activity once interest rates had pretty much hit rock bottom.
So a multi-pronged strategy focused on making borrowing cheaper and injecting much-needed cash into the financial system. What else did they do?
Governments also implemented significant fiscal stimulus packages, increasing government spending to try and boost aggregate demand and support employment. They introduced guarantees on bank deposits and certain bank liabilities to try and restore public confidence in financial institutions. And in some instances, governments even took ownership stakes in struggling financial firms to prevent a complete systemic collapse.
It sounds like an all-out effort to pull the global economy back from the brink. Were these extraordinary measures effective?
Well, while the global economy did experience its most severe downturn since the Great Depression, the broad consensus is that these forceful and coordinated policy responses did prevent a complete global economic meltdown. However, the human cost was still immense. Millions of people lost their jobs, their homes, and a significant portion of their wealth. And the recovery in many economies was considerably slower compared to recessions not associated with financial crises. For instance, in the U.S., the unemployment rate didn't return to its pre-crisis levels until 2016, nearly 8 years after the crisis began, highlighting the deep and lasting scars.
That really underscores the long shadow cast by the GFC. One of the lasting legacies seems to be a much greater emphasis on regulating the financial sector to prevent a similar crisis from happening again.
Absolutely. In the aftermath of the crisis, regulators around the world significantly strengthened their oversight of banks and other financial institutions. We've seen the implementation of new global regulations that require banks to more rigorously assess the risks associated with their lending activities and to rely on more stable sources of funding. For example, banks are now required to maintain higher levels of capital reserves and are subject to stricter limits on their leverage, reducing their reliance on that risky short-term borrowing to fund longer-term assets. There's also increased scrutiny on the interconnectedness within the financial system, with measures aimed at preventing the rapid transmission of risks.
It's always fascinating to look back and see how different countries navigated the crisis. Our source points out Australia's relatively strong performance during the GFC. They managed to avoid a major economic contraction and a full-blown financial crisis. What were the key factors that contributed to their resilience?
Australia's experience was indeed remarkable. While they certainly experienced slower economic growth, a rise in unemployment, and increased uncertainty, the impact was far less severe than in many other developed economies. Several factors were at play. Firstly, Australian banks had very limited exposure to the U.S. subprime mortgage market and to U.S. banks more generally, partly because their domestic lending operations remained quite profitable. Secondly, subprime and other high-risk loans constituted a relatively small proportion of overall lending in Australia, which is largely attributed to the Australian Prudential Regulation Authorities, or APRA's, long-standing focus on maintaining robust lending standards. And finally, Australia's economy benefited significantly from strong demand for its resource exports from China, whose economy rebounded relatively quickly thanks to a substantial fiscal stimulus package. So a combination of a more conservative financial sector and, well, fortunate external factors acted as a buffer.
So it wasn't just about avoiding the pitfalls of the U.S. market. It was also about having inherent economic strengths to weather the global storm. But Australia still implemented policy responses, didn't they?
Yes, despite their relatively stronger starting point, the sheer magnitude of the global shock to confidence necessitated a significant policy response in Australia as well. The Reserve Bank of Australia aggressively lowered the cash rate, and the Australian government implemented expansionary fiscal policies. This included providing guarantees on bank deposits and bonds issued by Australian banks to bolster confidence. And in the post-crisis period, APRA implemented the enhanced global banking regulations, and both APRA and the Australian Securities and Investments Commission, ASIC, further strengthened lending standards.
So even those who were more resilient still took decisive action and learned valuable lessons. To bring our deep dive to a close, what are the most crucial takeaways from the global financial crisis?
I think the GFC was a deeply complex crisis, born from a confluence of factors. You had excessive risk-taking fueled by a prolonged period of seemingly stable economic conditions, lax lending practices, and inadequate regulatory oversight. These vulnerabilities were amplified by increasing levels of leverage and tightly interconnected global financial markets. The collapse of the U.S. housing bubble served as the critical trigger, unleashing widespread financial instability and a severe global recession, the impact of which was, thankfully, somewhat mitigated by aggressive and coordinated policy responses.
And the contrast with Australia's experience really highlights the critical importance of sound lending principles and the significant advantages of avoiding excessive exposure to risky asset bubbles.
Precisely. It underscores the idea that while global events can have profound and widespread consequences, strong domestic economic fundamentals and prudent regulation can provide a substantial shield.
So, considering the significant regulatory changes that have been implemented and the painful lessons learned from the GFC, what are some of the potential new areas of vulnerability that might be building in the global financial system that could lead to future crises? It's definitely something to keep in mind.
Indeed. That's the crucial question for you to reflect on. In what corners of the financial world might new forms of excessive risk-taking be emerging, perhaps in less regulated or less understood areas? The financial landscape is constantly evolving, and a proactive and vigilant approach is essential to try and prevent history from repeating itself in unexpected ways.